Hey, good afternoon. All right, so once you understand the Fibonacci 23% strategy, you're really going to understand how you can use it in multiple ways. That now we can use it on the double bottoms, the double tops to find some more optimal entries and exits. Okay, so we're going to go through that right now. All right, first, also make sure you can go on your trading guy and you will see here, we got the Fibonacci trading overview, and here's hyperlink. It's 23% correction trading strategy. But go through all three of these, you understand what we're talking about in this actual video here. All right, so we are on the US dollar Japanese yen on the 30-minute chart, and I want to show you something. So we're going to take our fibs. So whenever a bottom two or top two form, all right, you want to take it from the point that create the neckline, which is here, and you want to drag it down to the last point that created the bottom two. All right, so what we're looking for is we're looking for right here. All right, so we're looking for price to cross back below the 23%. And if we cross above the 23%, it gives us a higher probability that we're more than likely it's going to go to the 61 for sure. And then if we cross the 61, of course, we know we have the 78 and the 88. So it's like crossing barriers. So remember, if this 23% is crossed, we have a high probability that we're going to go to the 61%. And if the 61% is crossed like it was here, we're going to go to the 78 or the 88. Once again, every strategy is not going to be 100%. Of course, you're going to have that's not going to do it. That's why I said higher probability. Now, have I did any empirical data and studies to give you the actual percentage? That's why I say a higher probability. For me, has worked a lot. I will need to do some crunching some data and do based off of probably a 30 trade batch, and then from there I can get the percentage. So I'll do that. I might do it this week. So it's going to take me some time to go back and actually do it. All right. So price what crossed. So we're here. All right, we get back up. We're above, but then price comes back down. Okay. So price is back down. Now let's take this off so we don't have any clutter, and let's look at this. All right. So look. Let's see if we can do a bar replay. There we go. All right. And we want to focus on this. A little bit of higher time. All right, so here we go. We're gonna measure this impulse. Okay. So I'm showing you how you can get into the trade if you already missed this and you feel like it's too late. You could wait for a what pullback. Why? Because we could use the 23% retracement rule. All right. Look, 23%. What happened? All right, we came up, boom, price came back up here across to what? The 23%. If it does that, we got a higher probability that's going to do what? Come to the 61, 78. And if that 61 is crossed, of course, we know we can go lower, but we're just going to go ahead and do this whole zone. And what does this mean? This means that this is an area where we could come into the market to look for entries. So you may say, well, Eric, what entry point? Well, you got this whole zone to basically play with. And there's some strategies we can use, but I don't want to give you defined because here's what you're going to learn about trading. Trading is one of those things where it has to become intrinsic. It has to be something that flows with everybody's rules. Is not going to be the same. Some people have hard, concrete rules. We may have some of those, but sometimes you got to get a feel for the market. So if I say, well, hey, well, you should only enter in on the 61%, and then if it retraced 80% or 78%, you're like, well, Eric, you told me to get it at 21. You get what I'm saying? So you have to know that, hey, I have a range. So you have a range of where you want to be able to scale into the market or whatnot. All right, so let's play one bar. All right, boom. We had a massive bar come into the zone, and you see it went a little lower, right? But regardless, we're in here, we're getting what? Field. Now, if you go to a lower time frame, you may see that There, of course, going to be multiple candles. This is 30, so you may get a little bit more market structure. But guess what? We're filled. We're in here. Whether you got filled here, whether you got filled here, here, or you did multiple entries, that's fine. Some people do that. What do I mean by that? Well, they may take a. I don't. Let's use just small numbers. I'm gonna do a at the 61. I'm gonna do a 10 cent lot size. If it goes down to 78, I may do a 30 cent or 40 cent lot size. So now I got 50 cent lot size, and then it comes down to your optimal zone, or maybe it's 78. You may say, hey, now I'm gonna do maybe a $5 lot size or whatever, with your protected stop loss below here, and you're gonna go up for your upside targets. That's just an example you can do. Um, like I said, I will make future videos where we can have multiple types of targets like that. But boom, there's that. All right. So we feel we're in. Of course, this is where we currently are now. All right. So what did you see me do? You see me use the fib retracement level on this minor move. Okay. So I could see that if I could get a pullback. So if you came into the market late and you see it already running, some of you do this. You be like, oh, it's automatically just going to go on up here and hit the neckline on a double bottom. Well, look what happens. You get all this drawdown. And if you're using a 30 pip drawdown, loss, you all right. So you will be good. All right. So if you did 30, you're right there. All right. So this is fine, but then you have to ask yourself, what would it look like in your account that you're down 17 pips? You got to ask that. If you took a standard, you're down $170. Would you like that? So some people see drawdown and then automatically panic. That's why I don't recommend you actually staring at your phone or staring at whatever um, platform you're trading on. The mind will basically start second guessing itself. You're like, oh my God, I got in late. I'm gonna it's gonna reverse. I got a bad entry. Now, yes, you did probably get a bad entry because you was chasing, thinking that this was just gonna go on up here, and then we get a pullback. That's fine, guys. Pullbacks is gonna happen a lot. You're gonna find them a lot. Uh, just because price left an area doesn't mean that the market is not going to go back and collect those what we call second load busts. Those students, they're still at school, they need to be picked up, right? So that's the analogy we use. The market makers need to go back and pick up additional students at school. Okay. Now, how can we get some targets? We always say we just go to the neckline, but you also can use the fibs as a target. And what happened? We did cross 23, came back. All right. What is our zone? Up here. Between what? 61 and that 88 particular zone. So you see, we're still here, but at the same time, the neckline is a overall better target. But we're sitting right in targets. So we could have took this trade, came in somewhere in here, and we up 30 pips. We could secure. We're done for the day. Depends on what lot size you take. $5, you're up 150. $10, you're up $300. And of course, you go higher. That's the money you made. All right. So this is a beautiful move. We made it. We're good. All right. And what do? We set our what? Stop loss. All right, 30 pip. Now, sometimes I adjust my 30 pip. All right. On this one, I think I only had like a 15 pip stop loss. I gave room. I gave room for it to breathe just a little bit, but at the same time too, I just felt a little confident, and that's what I was willing to risk today. I was like, I just risk 150 to make 300. Because if I pull it all the way down to 330 pips, that's $300 to make 300. That's just a 1-to-1. So this gave me a 1-to-2. So me doing a 1-to-2, that means I had to adjust my stop loss. All right. So then what happened? Price went into what? It went into profit. And guess what I did? I moved my stop loss into profit. All right. And then as they keep growing, I kept moving it. All right. To secure. Now I have taking some profits off the table. All right, already. Can we come up here and finish it out? Yes, of course. But I was satisfied with where I was at, and I can re-enter in if I need to. But I was satisfied with this trade, and it was coming down to a little end of the day, a little bit where liquidity can start to slow down a little bit. All right, let's look at this one over here. We had the same thing, had a double top, and we can see if we come up here to what created. So you got the first bottom, and then all right, we got this the first neckline. Bring it back down, and here. All right, so this one created it. All right, look what happened. We come across, and then look at this candle. Come back what below the 23%. Okay, so we can find entry. So if you come in and you see be patient and wait. So this strategy is used if you come into the market, you see a double bottom has already occurred or a double top. Throw your fibs from the bottom or top one to the neckline and see where price is currently at. And if it crossed that 23%, you can get ready to say, hey, if it comes back below here, below the 23%, I'm going to look for entry. And that's what we got right here. So we in, all right? So when this happens, when it crosses, it has a higher probability. Oh, but look at this. This candle automatically went and did what? It eliminated the 61 and the 70. All right. So when that happens, we have a higher probability that we're going to hit the actual target of the double bottoms. And here's the target. And you see what happened? We hit it. All right. So if you get a counter that just blasts through and goes up and didn't do a retest yet, you got a higher problem is going to go here. And then when that retest comes back below the 23%, instead of us taking it to the neckline now, we could say that, hey, we feel a little bit more comfortable. We're going to ride this all the way to the target. So you see how this works. All right. And then, of course, we just got to keep repping it over and over and over again. But that was a nice move of 77 pips to the upside. So you see how we're using a probability gain on when something does something. If it like if you know I don't know if somebody throwing a disc and it reaches a certain point, you can tell yourself like, hey, if that person has that much strength to get it that distance, we got a higher probability that they're gonna throw it further because now some wind is coming into the market, some wind is coming into the to whatever event that they're doing, and that wind is gonna blow it even further. So it's something like that. You get what I'm saying? It's like, okay, if it got to here and then it comes back here, you got to think of even a bow and arrow. That's what we usually use the word. The example, a bow and arrow. The further you pull it back, that's what your retracements are. All right, and then bam, it shoots up. So you can use that. I think that's a better example than someone throwing something. All right. Let me see if I can find a double top so we can see what that example look like. All right, so we're on the Australian dollar, US dollar 30 minutes. So all right, so we took it from the top down to the neckline. All right. Oh well, so we took it from here up to here, and we got the 23%. All right, so price started to drop. All right, but then it went a little further, but then price came back and crossed what? The 23%. All right, so it came back. So first it came and crossed, so it's going to give us a high probability that it's going to go where? 61%. All right. Now, if you came in late and you didn't see this, you can wait for price to come back across on the 23%, and this way it came back across on the 23%. All right. Now, see price move, we hit these levels, but if it crossed to what, 61%, you have another higher probability is going to go to the 78 or 88. The 88. And what do? We go there and we crush it. Okay. So you see the example with a double top, and you see the example with a double bottom. Like I said, I actually create some rules. I put up like a little PDF so you guys can have. They have the actual rules written down so you can get a feel for it. Um, so check that out. Now, when you look at the 23% strategy in the PDF, you're going to see um, it's going to be slightly different than what we just did here because I'm using this strategy inside of a double bottom and double top. So it's going to be vastly different. But I'm using some of the same principles and rules. And what you want to get to is that you want to be able to use these rules universally, like meaning that it can be done in stocks, crypto, futures, gold, commodities, all those things, right? So that's the beauty of this. It applies to all markets that you can use this. So why would we use the 23% when it comes to double bottoms and double bottoms and double top? Is because some of you may have come into the market a little late and the double bottom and top has already sort of started moving. So you can say, hey, if it retraces back to this particular zone, I will look to take entry. So it's more like a retest. So that 23%, okay, once price goes above that 23 or crosses to 23, look for a retest for coming out. Now, this trade strategy, I don't share this with everybody. I don't. This it's not. You can't find it on YouTube. It's not really unless I got a video out on it, which I have done before. That still may be out there. But for the most part, this strategy is something I have created and come up with just by analyzing the market. I needed to find what price zones is price moving above and coming back and retesting like what and if it does cross this zone, what is the probability that it's going to go hit this other zone? Now, this strategy is something that I've used. This is how I really have built my system up and being really really consistent. It wasn't double bottoms and tops. That was something that I saw that could be beneficial to newer people coming in, that they get them to focus and understand market structure. But that was not really my trading style. My style was I was a Fibonacci trader, and I still am. Now you're just seeing me now layering it and add it on top to give me more precision in the market by being able to identify key levels of where price could head to because it has given me some indication. All right. So I'm gonna start a video there, so it won't be long. But like I said, I'll work on the PDFs and build that out, and to give you more step by step and a little bit more rules based. But once again, remember I said that you have to also be prepared to uh, be fluid with your trading. You got to be intuitive. It's going to be certain things that I cannot teach, and some things you're just gonna get a knack for, and that's all part of it. So get out there, try, do your demos if you have to, do a small account, maybe start with $50, and don't go no higher than a 20-cent lot size until you get comfortable to add more. And that's it. All right, have a great day. Hit the like button, subscribe. Peace.